So the stock market's a little rough these days, right? Bouncing around left, right.
Yeah, I mean, the world feels a little rough these days, to be honest. So I don't blame the stock market for reacting in kind.
Yeah, obviously, when the market's volatile, the papers and the headlines are volatile. But then I think, have I ever opened up a paper and said, wow, everything's calm. Nothing's going wrong. We're good. And the answer is no, because the paper wouldn't sell if you had headlines that were like, we're all at peace. Let's go meditate.
Right. Although, I mean, if anybody's looked at their investment portfolio recently and, you felt a knot in your stomach, you're certainly not alone. And there are real things going on. Like, yes, headlines are built to be clickbaity and to get an emotional reaction. And we are dealing with ongoing tariff stuff, geopolitical tensions, tech sector swings, layoffs, and employment is a big question mark. Constant political, I don't even know what to call it at this point, but not anything that feels good on either side. There's a lot to carry in your mind, and then pair that with seeing, red when you log in to look at your investment portfolio. It's a lot. So let's talk about what's going on right now, and more importantly, what we can do about it.
Well, as we always say, the what you can do about it part, focusing on what you can control, is ultimately what we can do about it. Now, the actions that we take that are in our control are the keys here, because you could take an action, it's in your control, but it could be the wrong action at the wrong time. So that's really important to understand, what are the actions possible here? What are all my options? And which one should I actually be taking? Again, with the umbrella of all of these actions that we're going to be talking about are in our control, but they're not all right.
Yeah. So I think at a high level, the shortest possible answer to what is there to do? Well, if you have a financial plan with a sound investment strategy that's designed for long-term growth, then the best course of action, you've heard it before, may be to do nothing. Stay the course, stay calm, carry on. Again, that is the shortest possible answer. So we will get into what that means. And then if you don't have a financial plan or investment strategy, times like these are a pretty good signal that you probably need to get one in place so that you're not running around in a panic, or you're not scrambling to try to figure out, what do I do? You already have something that tells you how to get through periods of market volatility or geopolitical uncertainty, stuff even going on closer to home with AI. Like, what's the impact of all that on the job market and my industry? We're always going to have questions like that. So it's helpful to have something that is a guide. You don't have to question, what do I do next? You're clear on what to do. And as to why doing nothing is often the most powerful move to make, I want to get into that first, Eric, before we look at like what you can do, which you already hinted at. It's stuff that you can control, but it's hard to, I think, take the advice to like, do nothing. Like, we're not designed to sit and do nothing. So I want to look at why that is the right answer. A lot of the times is to just chill out, don't tinker. And I think the biggest thing that comes to mind right now is just the cost of being wrong with your timing when you do start trying to react to what's going on in the short term.
It's really tough to time the markets. I mean, that's something that we've said here before. Other people have probably said it as well. And the fact that you think you can predict what's going to happen next in reality, and then also predict how the market is going to take that information that would be new at the time, is just a loser's game, right? You can get right sometimes. You can get it right, maybe 1, 2, 3 times in a row even. I mean, you can flip heads 5, 10 times in a row. That doesn't mean that you know what the next one's going to be. And ultimately, if you flip the quarter 50 times, there's going to be heads and tails, and you don't know what timing is going to happen. So when you look at the market and you look at the long term, the best idea is to look at historical precedent, right? Like, what has the market done in the past? And then apply that information to the expectations for the future of the market, and then make decisions based on that. And the expectations for the future is that markets will increase, right? Economies will grow. Companies inside of those economies will grow. We don't know which ones necessarily, but overall, on average, they will grow. And so investing in the entire market allows your portfolio to grow over time, even though at very acute times, it could be very volatile. Markets could spike up, they could drop down, they could stay flat, but overall you have that upward sloping trend.
I like that you mentioned flipping the coin, because I think that just illustrates how bad people are. Like, you're just, anybody instinctually is understanding probability. Because if you take a coin, you have 50-50 chance of it being heads or tails. But if you flip that coin 49 times, there's something that says it can't land on heads every single time. And people are like, oh, that's not likely. Well, that's only the first 49 flips. What if you flipped it, it's 49 flips out of 1,000 in the sequence, right? Like, that's over time, that could be a probable outcome, but you just can't see the whole thing. You're looking at like, oh, it was just this 49 times, versus if you give someone a sequence that's more equally distributed over the 49 times, they'll say that's more likely without knowing how many times in total the coin was flipped. So it's just, we're not great at instinctually understanding probabilities, which drives a lot of our funny behavior around markets and money. So I'm glad that you said that. That's part of why it's a losing game, because we make a lot of assumptions that aren't true about how the world works, particularly with markets and in non-linear situations. And we tend to think in black and whites and binaries, where we think, well, it's either this or it's that as far as possible outcomes, but you didn't think about the 5 other outcomes that it could have been, those alternative possibilities. So there's a lot here that makes market timing difficult, including the fact that, so say you did get it right, you sold at the right time, you got out before the market crashed. Well, now you got to do it again, because you've got to get back in the market before it skyrockets again to catch that upward ride. And that's what's really difficult, particularly because the worst days in the market and the best days tend to cluster together. And the data on missing those best days in the market, even if you also miss the worst, it's crazy, because you missing out on those best days it's so detrimental to your long-term outcome.
Yeah. People are always talking about that. Like you said, like getting out of the market and then getting back in. I think the thought of it, theoretically, that sounds fine. Like, all right, I'll get out now. I'll miss this inevitable drop, which, by the way, is not inevitable to begin with, right? You can get out of the market thinking it's going to go down. It goes back up right away. And then you say, well, I'll wait till it goes down again. Then it doesn't go down again for 2 years, and you're sitting in cash. And so it's just this mind game that you play and gets very emotionally charged, and it's not a good place to be, right? So just from an emotional perspective, if you could just set it and forget it, you wouldn't be necessarily riding that wave of like, all right, what do I do now? What do I do now? What do I do now? Every single day of your entire life, really. And so you also look at well, when the market drops, I'll just get back in. Or if the market has dropped, it's time to get back in. It's safe to go in now. If the market's risen, well, it's going to go down next. And that's not actually true when you look at the numbers. I think we've probably said it on this podcast before, but if you look at the S&P over the last 100 years, and you look at periods when it has risen to a new market high, right? There's a new price point. It's never been this high before. And you look at the 1-year returns after that, and you look at the 3-year returns and the 5-year returns, the 1-year returns after a new market high are 13.9%. So about 14% increase over the next year after a new market high. And then over the 3 and 5 years, it's about 10% returns. And then if you look at the S&P, the same period of time, but the returns after a 10% decline in the market, and you look at the next 1-year return, well, it's actually less. It's 11%. But the 3 and 5 year are about 10%. So this tells us that whether the market has hit a new market high or it's declined at least 10%, the next 1, 3, and 5 year returns are all positive on average, and they're highly positive on average. So why would you ever get out when you look at the real historical precedent here?
I think fear is definitely a driving factor in answering that question, because I think even if you know all those numbers and you know the data, in the moment, it can just feel so overwhelmingly negative and bad and scary. So I think what helps to deal with that is to understand the other risks that are present. So like market volatility right now, if you're in your 30s and 40s, that's not actually the biggest risk to you and your portfolio. The biggest risk that you face is probably a permanent loss of purchasing power, like the ability to fund your life in the future. And for that, you need to be invested, like to guard against that particular risk. Are there other risks that you talk about with your clients like that, as far as like running out of money in retirement was the first thought that I had. which is where there's risk in going to cash and keeping your money in cash. Like that is as much of a risk to someone who is younger as like, oh, the market is doing something I don't like today.
Is the question like what other risks? Because I'd like to talk about that one risk in itself.
Yeah, sure. I'm
first.
Any and all. Yeah. I think, yeah, just that, like, I think it's helpful to define like what are these other risks that you're taking that you don't even realize that you're taking because you're so focused on this particular fear, not to like add in like, oh, you should also be afraid of these things, but it's more just reframing it of like, that's actually not the biggest thing that you should be worried about. And therefore that action is against your own self-interest here.
Okay. So biggest risks that may not be obvious is one category, but starting with just the first obvious one that we're just talking about as far as the market and not being in the market. I mean, I think there's the ability for us to look at your current circumstances, make some assumptions about the future, put in some realistic rates of return and say, based on your savings rate, based on your spending, based on your expected retirement date, like what does long-term look like for you if we project forward 20 plus years? And what rate of return do you actually need to achieve your most pressing goals? Like retiring at a certain age, paying for college, living a certain lifestyle later in life. Like what are those things? And what do you need as a return on your money based on the savings rate that you think you can achieve on an annual basis? Like what is the rate of return you need? And if the return in the projection says, well, you only need 5% returns, and someone comes to me and says, well, I'm a little bit afraid of the market. Should we get out? Should we not? What should we do? Well, I could say, well, you know what? Maybe the aggressive stance that we have in the portfolio, let's call it 90-10, 90% equities right now, isn't necessary to achieve your life plans. And you'll need a 5% return. So maybe we can reduce that down to maybe it's 70% or even 60% equities, which by default will help reduce the significant declines if the equity markets tank, right? So there's slight adjustments that can be made there because we've already proven that you need a certain rate of return. It's not as high as the next person. Now, that next person comes along and says, all right, how about my plan? And we say, well, you need 7% returns unless you significantly increase your savings rate on an annual basis, but you said you can't because your lifestyle is more important now. Well, we kind of have to rely on the extra aggressive portfolio here. And so reducing the exposure to equities and therefore reducing the drop potential in your portfolio isn't reasonable if you want to actually achieve your long-term goals. So there is some slight nuance into like how we can make adjustments to better align your risk tolerance and your emotional capacity to handle risk to your plan based on the circumstances that you have here.
I'm curious what else that you do along those lines. Like what are some of those nuances for the client portfolios that you manage at BYH? And I'm thinking things like diversification. I know that's a huge one and that sounds so simple on the face of it. Like that's again, kind of like stay the course. Like people hear that a lot, like diversify, don't put all your eggs in one basket, but it's not as simple as like a set it and forget it kind of decision, or like I'm just doing this broad general thing. It's actually a really nuanced conversation, and everything starts with that diversification. And it's what I think is like your kind of secret weapon against market volatility, especially of the kind that we're seeing now. So can you get into that a little bit of why is diversification so important and what are those nuances within it that people just don't think about when they hear the word and they process, like they know what it means, but they don't actually get it. Like, what is it doing for you in practice?
I do think that the word diversification is misunderstood. Like what does diversification mean? What's the extent of the diversification? Because I think a lot of times people will show up and say, I'm diversified. I own the S&P 500. And I think they're saying, well, it's not one stock. It's not 3 stocks. It is the S&P 500. So it's 500 stocks. Well, yes, but again, that's relative, right? If we look at true diversification, it is a much broader scope here. It's the global stock market. And so the S&P is a small portion. Well, it's a large portion, but it's less than the majority of all stocks, right? So you can invest in the S&P, but you're missing out on inside the US, you're missing out on US small companies, US mid-sized companies. And then you're certainly missing out on developed markets like Europe, Japan. You're missing out on emerging markets like China, Korea. So you're missing out on all of these places that can have big returns. over time. So we want to make sure that true diversification means not just the S&P, not just US, but global diversification, large cap, mid cap, small cap stocks, European developed markets, emerging markets, US markets, all of the above. And so you might end up with, say, 5,000 companies across the globe in your equity portion of your portfolio. We haven't even talked about bonds yet, but the equity portion would be that. That's true diversification. And so that if any one part of that does poorly, then the other parts potentially do well. And one thing about diversification, if you're doing it right, you're always going to be unhappy with at least one thing, if not more, in your portfolio, because some things are doing bad while the other things do well. That is why we diversify. And then people say, well, the S&P is still the thing to be in because it's the best, right? And a lot of times they forget about the lost decade, which was 2000 and 2000, the end of 2009. So it's a 10-year period where if you've invested in the S&P, you would have lost 9 or 10 cents on the dollar for the entire period of time. So if you think you're going to sit in a portfolio that has lost for a decade and not be antsy, get another thing coming, right? So it's not just about like, let's try to maximize returns. It's let's try to get pretty good returns and let's try to keep you emotionally stable so that you can stay in the market, because staying in the market, as we just talked about, is the most important thing. So how do we keep you in your seat, keep you relatively not, overly anxious, and achieve your long-term goals, which ultimately, again, is the most important thing. And so we can talk about a few other things outside of the market as far as like the risks that you don't know that you're taking that could demolish your plan regardless of what the market's doing as well, if you want to go that route.
Well, I think what you said there about staying in your seat is that's not a pushback that I've heard from people who are younger, who have kind of gotten this message drilled into them of like, all right, stay in the market, stay invested. They get that and they're willing to sit there, but they still don't have the right diversification. Like they're very heavily into US tech or the S&P 500 and thinking like, well, even if it does go through, like you were saying, another lost decade, like this period, it's fine because I have a really long time horizon. I get this game. I can sit still and handle it. But what they're not seeing is the lack of diversification isn't just like, oh, I might have a bad year with this thing that I'm invested in. It's the volatility that it creates. And that is where market volatility is not great if it's not managed in your portfolio. Diversification is a way of managing it. The more diversified you are, the less volatility you should see. And the reason you don't want high amounts of volatility is that even with the same average return over a long period of time, your compounded return will be less if you have higher volatility. And there's a chart that I think we can share in the show notes. It comes from Peter Lazaroff in his book, Making Money Simple, that shows the math on this of if you have, over 10 years or so, an average of a 10% return, you actually end up with less in the portfolio that experience more volatility because of the how the compounding works. Again, I'll share that chart so that you can see it. But that is always what sticks in my mind because I do hear that more often from people who are younger who have gotten the message of like, all right, stay the course. I'm good. I'll just sit here in my S&P 500 and that's all I've got. I don't have the diversification, and they're riding a huge roller coaster of ups and downs, not realizing that that's actually dragging down what their end result is going to be, not because they didn't stay in their seat and they went to cash, but because the volatility was so extreme, it dragged the end down.
Yeah, I think to put a cap on that for now, other than the example you're going to share in the show notes, is like just think about if a portfolio is $100,000 and it loses $50,000, that's 50% loss. Well, how much return does it take to get back to $100,000? It takes 100% return. And so you have to see a huge return on that money just to get back to even. Whereas if you had a 25% loss, like it takes a lot less, even though significant, to get back to $100,000 in that case. That's really important. And then even more so in retirement, because there's a sequence of return risk, right? So if you've probably heard this before, but in the first 5 years of retirement, if you experience negative returns, even if the long-term average is the same as someone who retires and experiences positive returns, your money is gone by a much quicker age on those negative years. So if you think you're just going to go guns blazing out there and try to get the most returns possible and hold on for dear life, Like the experience you have, one, emotionally is going to be hard, but also two, your portfolio might suffer because of it, because of the, I don't know, the greed or the feeling that you like need more money to survive and you don't actually need all the money in the world is very detrimental to the portfolio. So managing the mental hurdles of investing is as important as managing the operations of the portfolio, which is what we do in both cases, right? We have these conversations with clients and we hear them about what are you concerned about? And a lot of times it's not the market going down. It's like, well, I need to be able to fund my kids' college, right? And so that is more the problem. The risk is like not being able to fund college. It's not, well, I didn't get 10% returns in my portfolio, so that was really devastating.
Yeah, right. I think when you dig down, it's not, most people don't really want maximum return possible. They're just trying to guard against that fear of like not being able to fund those goals that are really important to them. And that makes it really hard to sit on your hands and do nothing, even when that's the right answer, because you feel like you're sitting by passively watching this happen to you, which is that's not a fun feeling. So in those cases where, you're tired of being told like stay the course, I think there is something that you can do, which is rebalancing, but with discipline. When markets move dramatically, like having a rules-based rebalancing process allows you to probably do not what you want to do, because really what's happening is you're buying the things that are less in value and you're selling off the things that have risen. So can you explain that a little bit, like why that's also a really important mechanism in an investment strategy, particularly when volatility is high?
If the portfolio is experiencing drawdown in various categories, assuming you're diversified and it's not just the one category that you're in, and you are rebalancing, you're taking a section of the portfolio that was, I don't know, a certain percentage, 60% of the portfolio, and it came down to 50. Rebalancing means selling the portion that is now higher than necessary. In this case, maybe it's bonds. If the equity market goes down and bonds go down or don't go down at all, but they don't go down as much anyway, then you're selling bonds to buy equities that have dropped in price. And that puts you back to the proper risk tolerance level in the portfolio to make sure that you're exposed to the right equities and bonds based on the plan. But at the same time, you're essentially buying the dip. Like people talk about buying the dip in a way that, well, let's sell out of the market, let's keep in cash, and then when it dips, I'll jump all back in. But you're essentially buying the dip when you're rebalancing, but you're staying invested the entire time, which is the most important thing. Right? We were talking before this podcast started recording about my thought of just like driving across the country. Two people are driving across the country. Undoubtedly, you're going to run into weather that is going to be challenging, whether it's rainstorms, thunderstorms, hurricanes, snow, whatever. One person might choose to get off the road and sit it out. And the other person might continue, but do so at a much slower speed to still be safe, but just moving along. If the assumption is that when the weather gets better, the one that stopped gets back on the road, the one that keeps going starts to go faster, and they're both going the same speed again because the weather's nice, there's no way the person that got off the road is going to ever beat the other person across the country. The other person kept going. You can't make up that time unless the one that kept going slows down. But why would you slow down?
Rabbit and hare fable. That is really financial planning in general, because that's someone who's like consistent, but maybe making smaller leaps of growth. That consistency is what's going to win out over time, whether it's planning or investments. Because the other part of this is contributing to your savings and investment accounts. It's not just looking at what's already there. It's continuing to dollar cost average. Like you put the same amount of money in every month, regardless of what's happening that month. You do that over years, decades of time, and you will be amazed at how far down the road you've gotten, even if you are making just small, manageable contributions, but you never stopped. And that's so simple, but it's not easy because life isn't simple, right? There's always something in the way. There's some distraction. Something comes up that you've got to deal with. So to do a simple, mundane thing for an extraordinary amount of time, like that's what ends up with crazy results that are really kind of hard to wrap your mind around in the present moment. But it's that consistency. If real estate is all like location, that's the secret to success in real estate, then I think it's consistency with your money management. That's really your secret.
The way that you can really take on volatility, if you're going to look at a spreadsheet, it is rebalancing, right? It's making sure that you're rebalancing consistently, even when markets are volatile. But also, a lot of people say like, well, maybe we should just back off the amount we put in every month until things settle down. Really what you should be doing there is say, let's push harder. If you want to grow your wealth, then ramp up the energy on the contributions in during those times. Don't slow down your contributions when times are good and then ramp them up when they're bad. Keep the rate that you think you need throughout all of it. But then when times get bad, throw in more money. Like if you want to take some more risk, like that is the feeling you're going to get. Like this is so risky because the markets are dropping and I'm just putting more money in. But if you look at the long term, assuming the upward sloping market, that is the right time to be more aggressive. And you are going to see that on your balance sheet long term. It's saving more money when you think you shouldn't be investing in the market. Because from an emotional perspective, it just seems at odds. But that's exactly the time to at least continue, or at best, contribute more.
Yep, that's a great way to redirect that energy of like, I got to do something, like, well, pile more money in right now because it's an opportunity for long-term investors. And that's even somebody who's in their 50s and 60s too, to some degree, because if you're in your 60s and you want your money to last until you're 90, then some portion of your assets is going to be in the market for another 30 years. So it's not quite apples to apples. It's not the same thing across everybody. It is different if you are retiring or retired, but I don't think it's as dramatic of a shift as people think of like, oh, when I get older, I have to be very conservative and very careful. And suddenly volatility is this big risk to me. Like, well, yes, you may need some portion of your assets, but what about the rest of it that's still in the market and you need to keep it there for decades still?
Yeah. Which just started to remind me of the things we were talking about before, like other things that could move the needle, even that are not just deciding on like, should I be in the market or out of the market, or like what my allocation should be. Taxes, right? We've been doing a lot of projections lately in our software for clients, and they have this new AI thing that kind of helps you plan with the client so that it can kind of throw ideas at you to say like, did you think about this? Did you think about that? And which I think is pretty cool. And one of those things it keeps bringing up, and one thing that we've always looked at long term, but it keeps throwing in there as an option, is Roth conversions, right? Taking your traditional 401k or IRA money, and when you retire, if you're retiring and showing not much income on paper for a segment of time, let's say you retire at 60 and you're not taking your distributions from your retirement account until you have to at age 75, if you're a younger client anyway, and your Social Security is not starting until 67. So you have this time between 60 and 67 where you're not showing much income. If you convert your money from traditional to Roth, there's a significant alpha on that investment strategy because you're saving money over the lifetime of your taxes. You're reducing the amount of taxes you'll pay later on because you're paying a lower tax amount on the converted amount while you're in a very low income tax bracket. So people get distracted by all this stuff. Like, what should I do? What should I do? And like, well, that sounds too simple. It's a tax thing. How about the investment thing? It's the after-tax money that we need in our pocket. It's not the top line returns on your money. So to sprinkling something like that in, to pay attention to paying as little as legally possible in taxes over your lifetime will automatically boost your net investment returns. So why not focus on something like that is completely in your control versus panicking about what the stock market's going to do tomorrow, which we have no idea about.
Right. I think that's a great way to, again, redirect that energy. There's so many planning things that you can do that you, as you said, Eric, have total control over. You control your savings rate. I know we beat that drum all the time, but it's so important. So if you feel antsy about something, look at your cash flow. What changes can you make? Where can you save a little bit more? Where can you contribute more to investments? It's a really powerful thing that you have a lot of influence over, and it's something you can do. If you have some nervous energy, you've got to get out. Instead of looking at your portfolio, look at your cash flow. As you said, taxes, like tax prep and planning, there's a lot of opportunities there. Even estate planning, like that's coming up a lot with our clients who are either getting their estate plans done, or they might have done the estate plan and now they need to make sure other beneficiaries are as per what the estate plan says. So it's funded in case they ever need it. And a lot of clients stall out over this. There are some that we're kind of hounding for like, please, please, please sign this paperwork to change your beneficiaries because you've done the hard work of setting up the estate plan. But now we need to get this last little administrative step over the finish line to make sure that you and your family are protected. So it's a lot of like housekeeping things like that too. Some administrative work with your personal finances that maybe you've been procrastinating on. Maybe you just haven't wanted to get around to it. But it's little stuff, you control it, it's things you can work on, and it makes a huge, huge difference in the end. So looking at those planning opportunities is a great way to do something about your situation, do something positive versus stressing out over your investment portfolio or checking it every day. Or that's just kind of a waste of energy. It's kind of like checking email on your phone, even though you know you can't do any work on your phone. You got to be at your computer, and then your mind sits and ruminates on it. I feel like it's the same thing. Like your focus is in the wrong place if you're just like, oh, what can I do with my portfolio? And you're ignoring this laundry list of planning items that you either just have a blind eye toward or you've been procrastinating on. I would say take this as your sign to kind of jump on that. You don't have to stay the course and do nothing, sit on your hands. You can take action with your financial situation and make a positive difference.
It's high impact planning. And that's what we focus on here. What is the biggest impact we can make on the plan next? And it's probably not how much tech should we have in the portfolio? Should it be 10% or 20%? No. I mean, if you're all tech, then yeah, maybe we got to do something about that. But it's not about that tweak, especially if I say, how's your estate plan? You say, I don't have one. And I say, how old are your kids? And you say 5 and 7. And I say, who's going to be the guardian? Would you like the court to tell you who's the guardian if you both are gone? Or would you like to tell the court who your guardian is? Well, then maybe get a will in place just to establish guardianship for your children if that happens. And then layer on top of that, well, is the guardian someone that can actually manage money well? If your retirement accounts go to the guardian to manage the money for your children, if you were to pass away, you both were to pass away as a couple, how do you feel about that? And if you don't trust the guardian to manage the money effectively, maybe you should have a trust. And then you establish the trust. You have a trustee that can be the financial guardian, essentially, of the money for your kids. You have the guardian who physically takes care of the kids, and everything is right. Then you say, well, I got the trust in place, but how do I fund the trust? How does the money actually get into the trust? Well, the lawyer told me that I had to put the trust as a beneficiary on my IRA account, and then my taxable account needed to have the trust as a beneficiary there as well after I take it from an individual account to a joint account so that we as a couple can manage it effectively while we're still here. Those are big deals. People say, oh, that's not a big deal. That's huge because something happens to you. The money has to flow the right way to get into the trust to make the estate plan work, ultimately to protect your kids, which for most people is the most important priority in their lives. Protect children. Don't get distracted by this day-to-day headlines and the markets. If you want to talk about risk, that's the risk that you're seeing right in the face and you don't even do anything about it. And so get on that. Like that's distract yourself, if you want to call it that, away from the market and do the right thing to make the biggest impact for your plan.
Yeah, I think that brings us back to kind of where we started, or one place that we did, where the best action to take is to get a plan in place if you don't have one right now. Because I know that uncertainty is genuinely uncomfortable, and everything that's going on in the world right now, it's not fun to sit through in the moment. But we don't have a crystal ball. No one can tell you exactly what the markets are going to do in the next 6 months. No one can predict the next recession, and anyone who tries, they probably have a vested interest in doing so because they're going to be right eventually, right? All these headlines that are like, this is going to happen. If they just keep putting it out there because there's no accountability for opinion and op-ed writers, they'll be right eventually. And they'll be looked at as like, wow, you knew so much when they eventually get it right. And then everyone forgets the predictions that they made that were wrong. So just remember, nobody can tell you exactly what will happen over the next 6 months. But what we can look at with some degree of confidence is that there are some principles and some rules-based things that you can do with your investments that will probably serve you well over time. So staying diversified, staying in the market versus going to cash, jumping around. Clients who do best are typically the ones who reach out to us and as their advisor and ask like, hey, can we talk through this? Because sometimes that even is the best action of just like getting your thoughts and your feelings out on the table and having someone be a sounding board so that you're heard, and that if any of these like planning items that come up in that conversation get dumped on the table like, hey, we can take some action here. Let's focus there. Let's put our energy there. So the clients who do well are the ones who take advantage of having an advisor. And if that sounds like something that you could use right about now, then you can schedule your own call with us by going to beyondyourhammock.com/schedule. And maybe now is the right time to get your own plan in place. That's a good first step for doing so.
Yeah. And if you're thinking like, I don't know what to do in these times, reflect on this. A lot of times when I show up to my client meetings and I say, do you have any questions about your investment portfolio right now? People say, no, we've talked about this. We got the plan in place. You said this was going to happen. So all we can do is let it ride out because, again, we are supported by the plan that we proactively put together. Right. And that's makes me feel great because we've done our job and they can rest easy, even in the eye of the storm that's happening today.
Thanks for listening to another episode of Money for Life, hosted by Eric Roberge, CFP and founder of Beyond Your Hammock, and me, Kaylee Roberge. Our show is produced and edited by Steve Stewart. If you want to learn more about wealth management and hiring your own personal financial advisor, visit beyondyourhammock.com. And now for the legal stuff. This podcast is for informational purposes only and does not constitute financial, legal, or tax advice, and may not cover all critical, complete details of every situation discussed. The views expressed by guests are their own and do not necessarily reflect those of the host or the podcast. Please consult a qualified professional about your specific situation before making any financial decisions based on this podcast or any other educational content designed for a general audience.